Subscribe to our YouTube channel and press the bell icon to get the latest updates.
I remember about a decade back when one of the leading private sector banks in the country launched its app, it was a huge deal. The bank hosted an event at a five-star hotel to offer journalists a glimpse of its path-breaking technology. Basically, it was the bank's app that allowed users to track their account balances on the phone and even make payments through it. I mean, the app was considered to be one of its kind offering back then, and the bank was seen as a leader in such fintech revolution, which back then was a newly coined term. But over the last few years, how often has it happened that your broker, your insurer, your grocery app, ride hailing app, food delivery app, almost everyone offers you a digital wallet? And once you sign up for such wallets, you have the whole host of financial offers and discounts at your fingertips. I'm sure that's always the case. In the past decade, the fintech sector globally has moved on from being the new kid on the block to becoming the norm across services. As the lines between technology and businesses blur, companies from any and every segment have jumped onto the fintech bandwagon. No wonder the sector has had a huge backing of venture capitalists. So, what kind of upside are VCs looking for in fintech stocks? And is every segment of the fintech business safe to buy into? I will tell you that in a bit. Hi, I'm Tanushree Banerjee, editor of Equitymaster's Blue Chip Recommendation Service, Stock Select. Welcome to Safe Stocks, where we discuss ideas to create and preserve wealth in the safest businesses. If you haven't subscribed to the Equitymaster YouTube channel yet, please do so and click on the bell icon to get notifications from my latest videos. So, coming to the VC-like mindset for buying fintech businesses. Please understand that it is not just startups, but even well-established banks and financial institutions in India that have realized the importance of technology innovation. They have been leveraging technology to build novel financial products and solutions for their customers. India, in fact, has been one of the pioneers of the global fintech trend, with over 2,000 startups and more than $20 billion worth of reported investments in this space as of 2021. A large talent pool, favorable regulatory climate, growing customer base, access to funding and public digital infrastructure to ride on, amongst other things, have aided the rapid growth of fintech startups in India. And despite a slowdown in economic activity during the pandemic in 2020, the fintech industry continued to showcase growth on various parameters. In fact, it is poised to report accelerated growth in funding, users and revenues even in the coming year. Perhaps the best example which demonstrates the growth of the fintech industry is the ability of the consumers to rely entirely on fintech services to fulfill all their financial needs through digital, contactless and remote channels. This was not imaginable a decade ago, when most banking and financial services in India required at least some personal interface for fulfillment. Now, India is a unique market where customers do not like to pay for banking services. Yet, the opportunity to creatively find revenue streams is very alluring for fintech companies. So, to just explain the fintech ecosystem to you, we have payment companies getting into digital invoicing, white labeling, card networks, and payment security. We have pure lending companies, or what we call NBFCs, offering home loans, gold loans, education loans, etc. But now these companies are getting into platforms for peer-to-peer lending, credit scoring, collection management, etc. We have had retail and SME neobanks for a while. Neobanks are basically small service banks that offer basic services free of charge. But when the customer wishes to upgrade to a higher value product, the bank charges fee-based income. So there are the neobanks now that are offering sophisticated credit-linked products to customers. And then, of course, there are scores of players in different segments of insurance tech and wealth tech. Within insurance tech, you have specialists in claim management and underwriting management. Whereas in wealth tech, apart from the broking and robo-advisory, you also have portfolio management tools, foreign investing, expense management and the like. So as you can see, the opportunities are so wide that no business wants to miss out on a share of the fintech pie. Now, isn't that a good thing? After all, India has always been a country relatively underserved when it came to financial services. We have barely managed to ensure that every household in the country has at least one bank account. And the rate of penetration of insurance and mutual funds still remains abysmally low compared to other developing economies. The problem is that in the fintech space, there can be too much growth too soon, especially in an era of cheap money. And unless that growth is calibrated with targeted risk control measures, it could literally blow up in the faces of entrepreneurs and investors alike. I believe the VCs are well aware of this issue, and therefore they are especially careful when investing in fintech businesses on these 4 to 5 parameters. Let me take you through them. Regulatory oversight. Now, data leaks, platform downtimes, and information theft has become quite rampant in the fintech space. Data is the backbone of fintechs. Developing a strong mechanism to protect data is of paramount importance, and players have to invest deeply in mechanisms to control this risk and comply with regulatory requirements towards data security. In case there is any regulatory oversight on data security of fintech, there can be a huge downside to businesses. Super apps. As fintechs mature with a strong user base and product market fit, they find more opportunities to diversify their revenue streams, giving rise to what are called super apps. Paytm is a good Indian example of fintech's route to becoming a super app. Paytm brought in variety of payments, loans, investments and insurance offerings on the same platform. And it also integrated e-commerce, VAS for merchants and consumer internet services such as gaming and entertainment in one app. While China has been a pioneer in super apps with WeChat, Alipay and Baidu, several other countries like Japan and South Korea also have their own versions of very successful super apps. In the US, of course, Amazon and Google are already such super apps. Super apps no doubt have a huge headroom for growth given the interoperability of services. But they could also, over time, invite the government's security concerns. Unsecured credit. I'm sure you've heard the term Buy Now, Pay Later, BNPL. BNPL is a short-term financing solution that allows customers to pay for their purchases at a future date, usually interest-free. BNPL offers frictionless credit during checkout as the key value proposition for customers. The BNPL growth is a global phenomenon, but the India story presents an exceptional market opportunity. In the massive Indian population and middle class context, the existing 60 million credit cards are not enough to address consumer credit demand. The existing microfinance businesses exploit this gap with very high interest rate credit. So there's a huge demand for such credit. But such unsecured loans, if offered without credit risk control, can blow up into a systemic bubble. Cheap insurance. According to Traction's database, India is home to about 325 insurance tech companies, amongst which just 2 have attained unicorn status, that is Policybazaar and Digit Insurance. This Indian insurance tech landscape comprises of policy aggregators, digital insurers, AI-based insurance enablers, claim management companies, etc. So the insurance policies are relatively easier to sell digitally. But offering cheap insurance may not be a great business model for investors to tap into. For over time, when claims come up, overselling cheap insurance may not prove to be worthwhile. And finally, commission-led advisory. Now we are all aware of banks acting as investment advisories for commission. Such commission-led financial advice can prove to be very harmful for customers during riskier times. So fintech businesses that focus on such commission-led advisory should strictly adhere to regulatory compliance. Else, there are high chances of mis-selling and eventually financial frauds. So if you wish to capture VC-like gains in fintech businesses, what you need to do is be mindful of the risks I just mentioned and do a careful evaluation of the risk-reward equation in such stocks. Hope you like this video. Stay tuned for more such videos on creating wealth in fintech stocks. Thanks for watching.